In this video, we're going to look at Skywest airline. It's the largest regional airline in North America. It mainly does business contracting with the major airlines. What I do in my videos is I run a discounted cash flow model to figure out the actual stock price of the company. And we also look at the financial ratios and compare them to its competitors. So let's get started with the model. The company has a market cap of $1.55 billion. That's the value of the company according to the stock market. And they currently trade at $30.82. Next, I'm going to pull the free cash flow. And free cash flow is the cash that's remaining after a company pays its expenses. So if you don't have much cash flow remaining, then it's hard to grow your business, and eventually you'll go out of business. Now I'm pulling the net income, which is the profit and loss on the income statement. And then I'm going to pull the revenue, which are the sales, and that's also an income statement. As you can see, in 3 years, they had negative free cash flow, but they had positive net income. So it looks like the company has been investing a lot to grow its business. Let's look at the capital structure of the company to figure out what discount rate we need to apply to the future cash flows. So the interest they pay on their debt is $128 million, and that was on the income statement. Now, to figure out how much debt they have, we'll go to the balance sheet. We'll go to the liability section. Under current liabilities is the current debt of $364 million, and that's debt that's due within 12 months. And under non-current liabilities shows the long-term debt of $2.6 billion, and that's debt due after 12 months. So they pay 4.3% interest on their debt. Interest is tax deductible, so let's get their effective tax rate. So their income before tax was $446 million. And on the income statement shows their income tax of $106 million. So the cost of debt is 3.25%. Let's figure out the cost of equity. We need the beta. The beta is how much the stock moves relative to the market. So a beta of 1 means the stock moves with the market. They have a beta of 1.85, so the stock moves roughly twice as much as the market. That means the stock is more volatile than the entire market, which means it can be more risky, or possibly provide a better return. Let's go back to the balance sheet to get their current assets. We're going to need this for later when we look at the ratios. Current assets of $760 million. Current assets are mainly cash, accounts receivables, and inventory. Now let's pull the current liabilities. These are debts and payables which are due within 1 year, and that's $924 million. And let's get their equity. That's total assets minus total liabilities, and that's $2.2 billion. And their EBIT, we'll go back to the income statement. That's earnings before interest and taxes. It's called operating income on the income statement. That's $534 million. So the cost of debt is 3.25%, and they have 58% debt in the capital structure. And the cost of equity is 16.5%. And we figure that out using the capital asset pricing model. And they have 42% equity in the capital structure. To get the weighted average cost of capital, it's a combination of the cost of debt and the cost of equity, which is 8.8%. And that's what we're going to use to discount the future cash flows. So I estimated 4 years of future free cash flows, and this is an estimation based off of prior years. I also estimated a future terminal value, which is all years past year 4. We discounted those numbers back to today's value, and we get a value for the whole company of $13.2 billion. We divide that by 50 million shares, and we get an intrinsic stock price of $263. It's trading at $31, so it's trading at an 88% discount, so it's a buy according to the model. Let's see what Simply Wall Street says the stock is worth. They're saying it's even higher. They're valuing the company at $314. So this was a hard stock to value because in my traditional DCF model, it came out with a negative value. And based off of the direction the company's going in terms of its financials, I had to use a more conservative discounted cash flow model. Let's look at the historical stock price to get some more information. So it looks like the stock was going up for several years. Then it dropped back in March like everything else. It's come back a little, and then it looks like it came back down. So it looks like it's a good value right now because both our models are saying it's worth a lot more. The reason the investing community might not feel the same way as I am and Simply Wall Street is because the future of the airline industry is questionable. A lot of people feel their sales are going to struggle and they're not sure how long that's going to occur or if they'll even be able to survive during this pandemic. Let's look at the financial ratios. That's an amazing PE, 4.6. That's price of stock over earnings per share. A really good price of sales of 0.5, price of stock over sales per share. And also a really good price to book of 0.7, price of stock over book value per share. And they do have a current ratio of below 8, so they can cover their current liabilities. So they either need to bring in more revenue or take on more debt. ROE of 16%, that's okay. That's income over equity. They have an interest coverage ratio of 4.2, so that really minimizes the likelihood of them going into default this year. Debt of 58%, which isn't too bad. The best way to look at ratios is to compare them to companies in same industry. So I've done 10 airlines now on this channel. American, Air Canada, Alaska, Copa, Delta, JetBlue, Southwest, Spirit, Skywest, and United. So if the number is in green, they are better than the average in that particular ratio. If they're in red, they're worse than the average. And if a number is in orange, like in Air Canada's 2.8 price to earnings, that means they're the best in that category. So SkyWest is better than the average. The average PE is 5.6 and SkyWest is 4.6. Value investors look for a PE below 15. The reason the airline industry has such low PEs is because their stock price has come down so much because people are really concerned about the future of this industry. They have a good price to sales ratio, but it's a little above the average in the industry. Their price to book is better than the average. The average is negative because American has a negative 66 price to book because they have negative equity in their capital structure. Current ratio, all the airlines are pretty much struggling in that category except for Copa and Spirit. ROE, Air Canada has the best ROE at 34%, SkyWest is 16%. And in terms of debt, SkyWest is 58% debt, which is higher than the average of 44%. JetBlue has 0%, so they're the best by far. They're the only airline that doesn't use debt financing. And in terms of market cap, SkyWest is a small company because they're just a regional airline, not a major player like American or Delta. So let me know what you think of the video. Thanks for watching.